At 3 a.m., when most of the world is asleep, trillions of dollars quietly move through the global financial system. No bank branches, no tellers, no government safety net. And yet, if this system froze tomorrow morning, your savings, your job, your country's economy, everything would feel it. This isn't Wall Street as you know it. This is the shadow banking system, and it controls more money than most governments on Earth. Here's the uncomfortable part. It operates outside the rules designed after the Great Depression, outside the rules that are supposed to protect you, and it's growing faster than anyone wants to admit right now. Let's start with a simple question that almost no one asks. If banks are so tightly regulated, why did the world almost collapse in 2008 anyway? Because the biggest risks weren't inside banks anymore. They had moved into the shadows. Shadow banking sounds illegal. It isn't. It sounds secret. Mostly it isn't. It's just financial activity that looks like banking, acts like banking, takes the same risks as banking, but isn't legally classified as a bank, which means it doesn't play by bank rules. No strict capital requirements, no deposit insurance, no central bank standing behind it in a crisis. Yet it lends money, it borrows money, it creates leverage, and it connects deeply to the real economy. Think of it like this. Traditional banks are hospitals. They're regulated, they're inspected, they're required to keep emergency equipment on hand. Shadow banks are pop-up clinics doing high-risk surgery without regulators in the room. Money market funds, hedge funds, private equity firms, structured investment vehicles, mortgage trusts, repo market dealers. Different names, same basic function. They take short-term money, they invest it in long-term risky assets, and they promise liquidity. That promise is the ticking clock. Here's why this matters now. In 2008, shadow banking was blamed, partially regulated, and then quietly allowed to evolve. Today, shadow banking globally controls over $60 trillion. That's nearly half of all financial assets worldwide.
In some countries, it's bigger than the traditional banking system itself. And unlike banks, it's harder to see, harder to measure, and harder to stop once panic starts. Let's break down how it actually works, without the jargon. Imagine you have $1 billion. You don't want it sitting idle. You want it earning money. But you also want it available tomorrow morning. Banks can't easily give you both anymore. They're regulated, they're slow, they're cautious. So you go elsewhere. You give that money to a money market fund. They promise safety, daily access, and a slightly better return. What do they do with your money? They lend it overnight to big financial players through something called the repo market. Repos are basically ultra-short-term loans backed by collateral, treasury bonds, mortgage securities, corporate debt. This happens every day, every night, in massive volumes. Now imagine something small goes wrong. The collateral suddenly looks risky, not worthless, just uncertain. Lenders pull back. Haircuts increase. Funding dries up, and suddenly institutions that depend on overnight money can't roll their loans. This is the shadow bank version of a bank run. No people lining up, no panic on the streets, just algorithms, contracts, and silence. That's what happened in 2008. Bear Stearns didn't fail because it ran out of assets. It failed because it ran out of trust overnight. Lehman Brothers wasn't insolvent in the classic sense. It was illiquid in a system that demanded constant liquidity. Shadow banks live on confidence, and confidence evaporates fast. Here's the uncomfortable math. Traditional banks must hold capital. They must prepare for losses. Shadow banks optimize for returns. They use leverage, borrowing on top of borrowing, turning small spreads into massive profits. $1 becomes 10, 10 becomes 30, 30 becomes systemic risk. And because they aren't banks, regulators often don't see the full picture. Risk doesn't disappear, it migrates. There's a quiet irony here. After 2008, governments tightened rules on banks to make the system safer and unintentionally pushed risk into places where rules didn't apply. It's like sealing one side of a dam and watching water surge around the edges. Now let's talk about the part no one likes to say out loud. Shadow banking isn't evil. It finances businesses, it funds innovation, it provides liquidity when banks can't or won't. Your pension fund relies on it. Your insurance company relies on it. Your government bonds often rely on it. Even central banks quietly rely on it. In 2020, when markets froze during the pandemic, the Federal Reserve didn't just rescue banks, it stepped directly into shadow banking markets, buying corporate bonds, backstopping money market funds, stabilizing repo markets. In other words, when shadow banks broke, the government still had to save them, but without admitting they were regulating them. That's the paradox. Shadow banks operate without the rules, but collapse with public consequences. Profits are private, losses are social. Now zoom out. Private equity firms buy hospitals, load them with debt, extract fees, and leave patients and workers exposed. Hedge funds speculate on government bonds of fragile countries, driving borrowing costs higher, triggering crises. Non-bank mortgage lenders issue home loans without the same safeguards, fueling housing bubbles. Again, all of this happens legally, quietly, with complexity acting as camouflage. And the bigger it gets, the harder it becomes to unwind. Because once a system depends on trillions flowing smoothly every night, you can't just turn it off. Regulators face a dilemma. Clamp down too hard and you choke credit. Do nothing and you risk another invisible collapse. So they compromise. Incremental rules, partial oversight, stress tests that assume rational behavior in irrational moments. History tells us how that usually ends. The system looks stable right until it isn't. Here's the final irony. Shadow banking exists because modern finance demands speed, yield, and flexibility. And modern economies are addicted to all three. We want higher returns without higher risk, liquidity without instability, growth without cycles. Shadow banks sell that illusion until reality collects its debt. So the real question isn't whether shadow banking will cause another crisis. It's whether the next one will be recognizable while it's happening. No crashing stock tickers, no dramatic headlines at first. Just subtle stress, tightening liquidity, and confidence quietly leaking away. And when it finally surfaces, the system will once again ask the same question it asked in 2008. Who is responsible for something that officially doesn't exist? And who pays when the shadows go dark?
Watch next. Subscribe, like, and share. Leave a comment below. Thanks for the support.